hello from Memphis. It's thundering here pretty hard. It looks like the bottom is absolutely about to fall out. So if we have a power interruption or something like that, I do apologize, but it's going to be due to inclement weather. So today we're going to do another market update brief. Again, we're doing these a little bit more frequently than we have been, and that's because there's just so much changing and going on that we want to make sure we keep up with current events and what's going on with the markets that can affect our portfolios. So, of course, the big question that's on everybody's mind. Well, before I get started, I just want to say again, Chelsea won't be able to be with us today again due to other circumstances. This time she's actually out of town, but so we will get back to a moderated format again soon, and I'll do my best trying to manage the Q&A and everything here in the meantime. So go ahead and share my screen here. And yeah, we'll go ahead and get started. So the big question right now is, are we in a recession or not? Which is kind of a crazy question to be asking, because in my opinion, it should be more of a definitional thing rather than an opinion-based thing. It used to be pretty universally 2 quarters of negative GDP growth, real GDP growth was what we called a recession. It kind of reminds me of, the S&P 500 is an example of something that's not just the 500 biggest companies in the United States. There's actually some arbitrary rules that they put in on who gets included in the index. And then also ultimately a committee just sort of decides who gets to be in the S&P 500 and who doesn't, which is not what most people would probably think. It also reminds me of CPI. You would think in the consumer price index that the housing number would be based on some actual data like house price sales or something like that. And actually it's based on, it's actually based on surveys. It's something called owner equivalent rent, where they go around and ask people what they think their house would rent for. And these people are not real estate professionals. They possibly bought their house decades ago. They have no idea. And that's what goes into CPI. So kind of an unusual thing that we have to guess. So I usually don't care for it when people start busting out dictionary definitions and things. You know, if you start a talk or a paper with Webster's dictionary defines so-and-so. But in this case, I think it's relevant. You know, Wikipedia is kind of the new dictionary. So, if you read through what they say, it sure enough refers to negative GDP growth, but also, some other factors that they consider. And then, it kind of snarkily points out at the bottom there, it says in the United Kingdom, it is defined as negative economic growth for 2 consecutive quarters. So we haven't declared a recession yet, but I think it's interesting to think about that. And what I've been saying in some of the stuff we put out is, if this is not a recession, then we need a new word for what 2 quarters of negative real GDP growth is. Because if it's not a recession, it's something we need to be concerned about, because sort of everything is based around the idea of GDP growing, at least per capita real GDP growing over time, which happens due to technology, productivity growth. Per capita isn't affected as much by population, but GDP growth is sort of the glue that holds our entire economic machine together. And if it's not growing, then things like stock markets will have a hard time growing. People ultimately have a hard time finding jobs and all those sorts of things. So you can see here that obviously this is a shorter look, and this is not year over year, this is quarter over quarter. So you can see we did have a recession, and sure enough, there was 2 quarters of negative GDP growth around 2020 with the lockdowns. And it's a real interesting question. You can see this observation here was first quarter of 2020, and had the lockdowns not started, it's interesting to wonder if we would have had a little bit of a recession there anyway, that maybe we just kind of postponed severity of. And you can see this big growth here with all the support the market's got. But sure enough, if you look here in 2022, we've had 2 quarters where GDP growth has ticked negative. And if you look at this is not a logarithmic. This is just a regular chart showing real GDP back to the 1940s. And you can see, sure enough, every time it ticks down a little bit, it looks like we did call it a recession pretty universally. So if you, rather than looking at the time series there, if we actually look at the percent change in real GDP quarter over quarter, you can see it's hard to find an observation where we had a negative GDP growth quarter, real GDP growth quarter, where it wasn't a recession. These gray bars indicate recessions, and you can see some are more severe than others. But it is interesting that we've ticked below here, and as of right now, we're not calling one yet. But of course, I think probably that's on the horizon. One other thing that people look at for recessions is tax receipts, income tax receipts, and other receipts from the federal government. And you can see that sort of correlates well too, that when there's downturns in that, there tends to be a recession. But actually, sure enough, our tax receipts are up huge right now. And probably a lot of that has to do with some of the profits and the income that we've seen from coming out of the lockdowns in the pandemic. But this is the percent change quarter over quarter of federal tax receipts. You can see there have been some observations that going negative that weren't called recessions, but it is interesting that this is a little unusual. We have a big positive spike, which maybe muddies the water somewhat if it's going to be actually called a recession. That's the same chart again. This is from our friends at Dimensional, and I think this is a really important thing to keep in mind. So they took a look at the global financial crisis in 2008, and it's really interesting to notice that you can see the green here was what was declared as the recession, December of 2007 to May of 2009. And what's interesting about that, as you can see, they didn't declare that the recession had begun until December of 2008. That's sort of when they said the recession retroactively had started. And what's interesting about that is by the time they declared it, it's almost over. You can see there was a couple more quarters of recession, and then things started climbing. The stock market bottomed, and then other economic indicators started rallying as well. And it wasn't until, that was December of 2008. And it wasn't until September of 2010 that they decided we were out of the recession as of mid 2009. But you can see if you were trying to invest based on them calling recessions and then calling recessions as over, you can see there's a huge lag. And in fact, some of the best stock market returns in history happened, not ironically, during that period before the recession had announced is over. So when people are saying they want certainty, they want to wait until they have more information, that's usually a great sign that it's probably time to invest. And sure enough, if you look at the very short recession around the lockdowns in 2020, it was a similar story, except it wasn't until, we all remember this, so this is easy to keep in mind, that recession was very brief, and it went from February until April of 2020. And what's interesting is they didn't declare that a recession had started in February of 2020 until June, and then it actually breaks the scale. You'd have to wait all the way until July of 2021 to find out that we had come out of the recession. So that's pretty interesting. Okay, there's a question of who, sorry about that. There's a question of who is Dimensional, and the answer is, that's actually a great question. If you're a client here at Telluride, then you probably should see, you should frequently see their name because they're one of the main providers of funds that we use here at Telluride. We use Dimensional. We've also brought research affiliates on board a number of years ago to diversify our managers, and then we do use Avantis funds as well. But Dimensional, and we have a whole presentation on that on the website that you can see. That's our investment session presentation. But Dimensional was essentially the first firm to take the academic research that was coming out in the 60s and 70s and early 80s and actually start applying that to investing. And they don't market too much to individuals. They more focus on advisors like us, but it used to be, it was very difficult to get Dimensional funds, but now along with the other providers, they've started launching ETFs. So pretty much anybody can own Dimensional these days, but they're very much sort of thought leaders, both on portfolio construction, and they have a lot of great materials like this for people like us. So this was, I thought, pretty useful. And one last thing we'll talk about on the question of recession is leading economic indicators. That's all the things that supposedly will telegraph in advance what's going to happen with market, not just market, but the economy itself and what's going to happen. And you can see usually this basket of, and it's things like the stock market actually is considered a leading economic indicator. There's a lot of other ones. I don't have a list in front of me, but just things like purchasing, inventories, things like that. When inventories start piling up, that could mean that we're in for a boom because people are trying to stockpile more inventory, but more often it means that whatever rate people were ordering things was too much, and now sales have declined and inventories are starting to pile up. So that's an example of an LEI. And you can see that actually probably, you could sort of like a Rorschach test, you could look at that either way. You can see almost always leading economic indicators have predicted recessions. And in this case, we have still seen growth in positive trends in leading economic indicators. Granted, the second derivative is coming down. You can see it's gone from something like 10 or 15% down to 1.4%, but arguably that still is a favorable observation. And of course, if this trend continues, then we're going to see this jump negative. And it's not perfect. You can see it has dipped below zero in some cases where a recession didn't come right away, but generally it's a pretty good predictor. So on one hand, you could say, well, leading economic indicators are still positive. And on the other hand, you could say the trend's not going the right direction. But ultimately, I don't think it really matters because the bottom line is we've had negative GDP growth already. So again, you can call that a recession or not. You should call it something. That's really, I think, the thing to focus on. And we're fortunate that the labor market is strong and that hopefully jobs can continue to be strong while we fight inflation and bring it down. But by that metric, I feel like we're kind of in a recession already. But the good news is, again, we might be towards the end of it, like these slides indicated. So, and this is a slide from JP Morgan I like to show. And we've done this the last few briefs we've done, but I'm just going to dwell on it one more time because I think it tells such a fascinating story. So the gray line is consumer confidence, consumer sentiment, and you can see it goes up and down. And the blue dots are observations of the stock market return for the next year following these peaks or troughs. So for example, you can see when consumer sentiment gets really high, the stock market doesn't do that well. 6.2% down, that's kind of anemic. 13's okay, but after 2000, you can see these numbers are very low. But ironically, when consumer sentiment is very low, that's when there's extremely good market returns in the coming year. So by that metric, you can see that consumer sentiment is down to about the worst level we've seen, at least in the last 50 years or so. But that probably means some bad stuff has happened, which is true. We've had the coronavirus lockdowns, and now we've had some challenges geopolitically and otherwise. But when consumer sentiment gets this low, inflation obviously is a big problem, but that usually means the stock market's going to do pretty well going forward. So hopefully this chart will continue to work. So the bottom line is, are we in a recession? Probably, but ultimately that word's kind of meaningless because it's just decided by a committee. But I'd say we definitely had two negative GDP growths, which hopefully we're going to start recovering from. So looking at the stock market, you can see we backed off some, but we're still pretty strong. I mean, we're only touching the lows we experienced in, not even the lows, but we're touching levels, at least in the S&P, that were last seen in 2021. So that's not anything like this when we talked about having a lost decade, going from the peak in 2000 wasn't really reached again until 2008, and then it was kind of a double top. It didn't get reached again until maybe almost 2013, 2014. So we're still doing pretty well compared to history. And as you zoom out, of course, this looks more and more like a straight line going straight up, and it's even a logarithmic scale. Always, the stock market will continue to be the cornerstone of our everybody's retirement plans, and the reason you can retire without every dollar that you need for the rest of your life. So just looking at across, this is something we look at internally every day. And it just kind of gives us an idea of value versus growth. If you look longer term, you can see growth has been outperforming. And a lot of that's due to the rise of the FANG stocks and some unprofitable companies that have done well and then caught a bid during the lockdowns and everything. But I kind of focus on the year-to-date number, and of course, years are arbitrary time definitions, but that's something that sticks in everybody's head. And you can see if you look at the green observations, sure enough, this year what's working is S&P 500 values, that's large cap value, Russell 2000 value, that's small cap value. Small cap in general is kind of in a yellow zone. And really what's struggled some, in addition to tech and S&P 500 growth, which have struggled, international and emerging positions have struggled. And a lot of that, there's kind of a 1-2 punch of the uncertainty with energy from the Russian invasion of Ukraine, but then also the ever strengthening dollar. We've talked about before, but the dollar is very strong right now. And that's kind of a mixed bag for us. Honestly, it's good for some reasons, but it hurts our exports. And certainly a strong dollar is difficult for international and especially emerging companies that have to buy things like oil in dollar denominated purchases. Things get a lot more expensive for them. But the good news is that probably won't last. A lot of people I follow are talking about the likelihood of the dollar backing off for a number of reasons in the coming 6 months to a year. So that could catch a bid. And again, the nice thing is, if you work with us here at Teleray, you're pretty well diversified among all these sorts of asset classes. We definitely have a value tilt because of the evidence of long-term outperformance of value compared to growth. And again, value sounds good, but you'd think, well, I want some growth too. But in this context, all it really means is cheap and expensive. So value stocks are the ones that have low price to book ratios, price to earnings ratios, things like that. And growth are companies that tend to have higher valuations. So we like to see growth in our portfolio, just not with the things that academic people call growth stocks. So looking at what's working, you can see this sort of anchors the S&P 500. And you can see there's a number of years where the S&P was one of the best performing things, but this year it's definitely not. Commodities have had a great year this year. And part of that is because they've had such tremendous underperformance for so long. For a lot of decades, actually stocks and commodities actually performed relatively similarly. Stocks, I think, did have evidence of long-term outperformance, but stocks and commodities and even bonds actually had a number of periods where they did pretty competitively compared to the other two asset classes. So, but you can see if you kind of zoom out and just kind of defocus your eyes, you can see commodities kind of have lagged almost every year in the last 10 years or so. And so that probably means that, it's not surprising that they would catch a bid here, especially with the macro influence from the lockdowns and everything. So again, commodities aren't something we specifically allocate to in our portfolios. And the reason for that is that really the expected return on commodities in the long run is zero. You'd think you want to own commodities and things like gold and silver and all that. But really, they might keep up with inflation, but they're unlikely to beat inflation in the long run. And the best example of that is in a previous presentation, we went through and looked at, we kind of searched, and then we had a little bit of, I almost call it original research. We searched a full text version of the Bible to find references to gold and silver. And I think we found a part where they referred to how much silver it took in this coin that you can still know the weight of today and know the purity and everything. It talked about how much silver it cost to buy, I think, 6 loaves of bread. And we figured out, again, I could go back and find it, but basically the real return on owning silver, essentially, depending on what kind of bread you look at, it basically hasn't changed in 2,000 years. The amount of silver can still buy the same amount of stuff 2,000 years ago that it can now. And granted, there's probably a lot of things you could own 2,000 years ago that are worthless today. But on the other hand, especially once capital markets started to get developed that were investable, anything that's sort of equity linked that actually has earnings and things like that dramatically outperforms commodities. So hope this was useful. We talked about the FANG stocks. This period, the last 5 years plus, they really outperformed. The S&P 500 is in gold here. But then we had sort of the great catch up where they really struggled after the lockdowns ended. And now they've rebounded a little bit, but also so has the rest of the S&P. Actually, July, after we've had a challenging year, but July was one of the best months on record for a number of asset classes, and a lot of things caught a bid, like technology and Facebook, Apple, Amazon, all that stuff. So, but we still believe that these companies, they're very profitable, which actually is a factor that we allocate to and believe in as part of our portfolios. But with that said, they're also very big, and there's great demonstrations that our provider Research Affiliates puts on, where they look at the biggest companies in the world every decade on the round numbers, like 1980, 1990, 2000, and essentially the 10 biggest companies in the world. Each decade, by the next 10 years, almost always have been displaced, either because they just sort of got overrun by other up and coming companies, or in some cases, in 1990, something like 6 or 7 of the biggest companies in the world were all Japanese, and we all know how that ended. But around 2000, oil companies were huge, and they're still big. But the point is, I would be surprised if investing in the 6 FANG stocks today would result in market beating performance over the next 10 years, certainly. I mean, I could be wrong, but I'd be surprised. You can see that, again, we look at this every time because it's interesting to see where we stand as far as valuations. But just one metric is forward price to earnings ratio. So looking at the next 12 months of expected earnings. And you can see that we finally, we were kind of at a relatively average valuation for the last 5 or 7 years, but then we jumped to pretty high valuations after the lockdown started, and then we've actually dropped back down, both as a combination of rising earnings and also a little slowdown in the price run-ups that were happening. That really, on an average basis, we're actually not too far off from long-term average PE type ratios. The Shiller PE ratio, they also call it the CAPE ratio, looks at the last 10 years of earnings compared to today's price. So that helps smooth out some of the macro things. And you can see, going back to the 30s, we averaged around 15 or so. And around the late 90s, there was sort of a regime shift. And now the CAPE ratio averages more like 25 or 30. But you can see, again, at least in that new regime, we're kind of back to a more reasonable valuation. So people are always asking, is now the time to put more money to work? I got my bonus, I got an inheritance, I got a windfall, I won the lottery. Well, nobody really tells us they win the lottery. But, Jack Bogle from Vanguard has a great thing on that. And the answer is almost always yes, just put the money to work. But I guess I would feel slightly better putting the money to work when valuations are closer to a longer term average than when they were up here. But my philosophy, even with my personal money, is, that you could argue that this whole period here since 1995 has been unusually highly valued. So you could have, in 1995, you could have said, well, I'm going to wait till valuations come back down to 15. And other than a brief window in the crash of 2008, they never did. So that would have been the exact wrong thing to do. And I definitely don't believe in trying to time the market. So, my answer would still be, I think it's probably a good time to put money to work, as good as any time, because you just want to spend time in the market, not time timing the market. And I really do believe that. So go ahead and go on here. This is a box and whisker plot. So again, the 0, this is showing if you're cheap or expensive compared to long-term observations of these different valuation metrics. So just for example, so the way the box and whisker plot works is the 0 line is the average. The next bar here is the median. So the median is a little bit below average for price to earnings ratios, but the box itself is the 25th and the 75th percentile observations. So 50% of the observations fall in here. The whiskers out here get 95% of the valuations. And then, there can be observations even above that. So you can see a year ago, we were up towards, 2+ standard deviations expensive for all of these different ratios, which again was kind of concerning. And sure enough, the market has backed off a little bit. But now, while we're still above average a little bit, we've fallen down to much more reasonable levels compared to historical observations. And these were even lower last time we looked at this. They've popped up a little bit with the performance of the S&P, but I wouldn't recommend timing the market, but I guess I'd feel better about investing now that these diamonds are here rather than up at these X's where they were a year ago. And this also shows that valuations have come down for both United States, developed non-US markets, and emerging markets. And you can see that the US is still a little bit above average compared to historical observations going back to 2013. But both developed non-US and emerging are actually probably right around their long-term averages, or maybe even emerging has dipped slightly below. And again, a lot of that has to do with the strong dollar. It has to do with conflict in Ukraine, energy concerns, but this also is reassuring as far as diversifying internationally, which is something we definitely do here at Teleray. So now this slide is, so what we just looked at here is forward price to earnings ratios. So that's how much it costs to buy $1 of earnings in these markets for the expected earnings over the next year. But here is we're looking at global price to earnings growth. So it's how much you're paying. Obviously, all things being equal, if a company or a market is growing more quickly, you would pay more because you'd expect your value to go up sooner. And what's interesting about that is it kind of reverses. The US is still looking a little bit above average, but actually developed non-US looks very expensive from a price to earnings growth ratio standpoint, whereas emerging is probably a little more attractive than the US and probably closer to in line with long-term averages. And again, I think the main reasons for this, Europe is especially, they're subject to the problems of the dollar appreciation and the fact that oil and things and international trade is often undertaken in dollars. But more importantly, they're right on the front lines of the Ukraine conflict, and they actually have pipelines with energy in them that is at risk of being shut off or curtailed or all those sorts of things. So, their earnings growth has really decelerated, and that's why they look kind of expensive on this metric. And again, we wouldn't really want to guess or try to predict the future of which one you want to be in. We have long-term allocations to each of these markets that get rebalanced over time. And rebalancing is sort of the magic way that you actually can mechanically buy low and sell high if everything works the way it should. So, we're in these markets and we're rebalancing, and, we think that's the best way to stay invested and stay the course through this kind of experience. And we kind of already looked at this. This is just another look at S&P price to earnings ratios. This chart we always look at. Again, we are pretty invested in value here. And you can see this chart, we won't belabor it, but the point is this green line is about average of value versus growth. So when the gray line is dropping, that means growth is outperforming, which we've seen for a few years. But we've seen a pretty big rally in value recently, and you can see that's just a tiny blip, really, going back in the other direction. So the point is, there's a lot of room to run still for value. So we're very optimistic about that. So we're going to talk more specifically about inflation for a few minutes, and then we're going to get into the actual discussion of the Fed and what they're up to these days. We led again with gasoline prices because that's probably the thing that influences inflation the most. And it is a component of CPI, but more importantly, everything sort of gets passed through oil, whether it's international shipping or travel or airlines or all those sorts of things are all intimately tied to gasoline prices. So as we see gas prices come down, we're definitely going to see that headline CPI number come down. And people think I'm crazy, but I'm going to stand behind it. It's possible that if we saw a resolution to the conflict in Ukraine or more supply come online, gas prices have already been falling sharply, as you can see. And it's possible that it could continue to fall and actually pull that headline inflation number down even lower. And you can see, it's good. The next slide is right here. So core CPI is X food and energy. And you might say, well, why would I exclude food and energy? Because I use food and energy. The answer is it's so volatile that it obscures the real trends going on. So, for example, you can see core CPI is about 6%. Headline CPI, including food and energy, is about 9.1%. And we're actually going to have a print tomorrow, which hopefully will come down a little bit. But if oil prices came down a lot, it's possible that CPI, headline CPI, could leapfrog below core CPI. And actually, I mean, it's unlikely, but it could even be a very low single digit number, or headline CPI could even temporarily show a deflationary number, which wouldn't really be true deflation because this core inflation is still there. But that's why, CPI is considered sort of an unreliable indicator, and people actually do pay attention to core CPI, even though obviously food and energy are pretty important. I think this is really important, and we talk about this a lot as far as trying to predict what's going to happen to inflation. There's a lot of information out there that you can look at. The Fed has a vast trove of data that they review. But what's really interesting is there's people in the markets that are specifically betting on inflation. And what that means is with TIPS, which is Treasury Inflation Protected Securities, if you compare a Treasury bond or note or something like that to a TIPS bond, what it means is that the Treasury itself will have some performance. And then based on the break-even rate that is indicated by the TIPS price, if you buy a TIPS bond, depending on what inflation does over the next period of time until the bonds mature, you'll either underperform or outperform treasuries. And so what this is saying is that for the market participants that are buying TIPS, which is actually, I mean, there is some mom and pop buying through ETFs and mutual funds, but really a lot of these are very sophisticated practitioners, hedge funds and things like that are very, they may not always be right, but they tend to be data driven and not opinion driven. And you can see that they're betting over the next 10 years, inflation is going to come down to 2.5% in an annual basis. And even over the next 5 years, it's only going to be 2.6%. So what this is suggesting is that these people who they look at the same kind of data the Fed looks at, but they also, I mean, they, go out to shopping malls and count cars in the parking lot and look at trains to see how loaded they are and count freight, 18-wheelers on the interstate and stuff like that, and how loaded container ships are coming from China. So it's not like they're just guessing. I mean, they have very strong opinions, and you can see that on average, these market participants are suggesting that inflation is going to come down. I mean, what's interesting about this is over the next 5 years to get 2.6% annualized inflation, well, we're already at 9% right now. So it'll have to come down even quicker than you think, and probably go to a level much lower than 2.6% in order to average out to 5 years of 2.6% inflation. So this is a pretty strong indicator that they could be wrong, but these market participants are discounting that inflation is probably going to get under control pretty quickly, which is good. It means the Fed is credible, all those things. We get some price stability if they're correct, but it is reassuring. And then we always talk about this too, because unlike most things, we talked about not LEIs, but we talked about consumer sentiment, where it was kind of fascinating that it's exactly wrong. When consumer sentiment is high, the market does poorly. And when consumer sentiment is low, the market tends to do very well over the next year. But the thing that's unique about inflation is that people's opinions on inflation actually matter when it comes to what's going to happen to inflation. Because again, some people, especially people who have lived through the inflation of the 70s, have told me that inflation is almost a mindset. And the example I always give is my former boss said, they would think about buying a new car in the household. And, in the 70s, it was not, can I afford a car? It was, we better get the money together to buy a car this year, because next year we won't be able to afford it because the price will probably go up 10 or 15%. So, and that's an example of where that mindset actually could be a positive feedback loop that drives whatever people are thinking, the expectations. So again, if you look, back here, we pointed out that people buying TIPS estimate inflation at 2.6% over the next 5 years. Well, people that are being surveyed, they expect about 2.9%. So it seems that consumers do agree with Wall Street that inflation is going to get under control. And 1 year inflation at 5.2%, so the price level today over the next 12 months, how much is going to go up or down? I personally wouldn't, it'd be difficult to take that over under. I'm not sure if I'd guess it'd be higher or lower than 5. I hope it would be lower. I think it would be lower by a little bit, but that's just my opinion. And it's just as worthless as anybody's opinion when it comes to that. So again, we're data driven and we'll continue to watch it. But the nice thing about being a Telray investor is that even as chief investment officer, my opinion doesn't really matter because we look at the data, the evidence, we use providers that use an evidence-based approach, and your success or failure as a Telray investor is not going to depend on my or anybody else's ability around here at guessing what the Fed's going to do next week or tomorrow or what the next inflation print is or anything like that. So we can't get away from inflation without talking about housing. Unfortunately, this is still an old data point here, but it does feel pretty strongly like the housing market is taking a turn. For better or worse, I guess it's worse only if you're about to list a house or if you're some kind of a property flipper or real estate flipper. But that is some indication that I think this is probably going to turn based on some of these leading housing economic indicators, like we talked about that concept. So you can see housing starts are down a little bit, but they're still pretty strong. There's still a lot of demand for housing. And this next slide here, building permits look very similar. That's obviously building permits even leads the housing starts, and you can see they have a similar trend, but they're still hanging in there pretty strongly. But existing sales definitely are taking and this is a little bit of a misleading scale here because this number here is not zero. It's 5 million existing house sales over the month. So that's an awful lot. So, but you can see that we did peak out at about 6,500. So that's down almost 30%, I'd say, from around 30% from the peak we saw in January of 22. So definitely we're seeing a slackening of demand for houses on the market that really, at least for this scale, going back to the lockdown times, it's unprecedented in a very short time frame. It definitely indicates that housing is starting to cool off though a little bit. You can see another indicator. This, since last time we looked at it, has jumped up significantly more. The month supply of inventory is 9.3 months, which again, that's just looking at how much is on the market divided by how many sell each month. And we haven't seen that level of inventory since the very, coming off of the peak around the 2008 crisis, which that's definitely concerning, seeing that number there. And this is new inventory. So it's interesting that, where did it go? Housing, people are still building, people are still pulling permits and building, but it's interesting to see the inventory is coming up. So if you are on the market for real estate, it could be that means that there's some good opportunities and some good deals that might be coming. And of course, with mortgage rates pushing up into the 5% range, not surprisingly, refinancing is off significantly, which is definitely a problem if you work in the mortgage industry. Banks make a lot of money doing this. So it directly impacts some people, but more importantly, I think it just is an indicator of how quickly mortgage rates have jumped up. You can see, going back almost 10 years, we haven't seen this low level of mortgage refinancing really in quite some time. So we'll close out and talk about the Fed. It's interesting. This is the chart we always show. So if you go back to the beginning of the year, this is what the yield curve looked like, and it was nice and flat. Nice and steep. Actually, it had a nice shape to it. And there's a lot of speculation that that's because the Fed was essentially practicing secret yield curve control, meaning that since they were buying bonds, they could choose to buy wherever they wanted to on the curve to hold short rates down more or prevent the curve from inverting or keep mortgage rates at a reasonable level. But you can see the gold observation is at the end of the second quarter, so June 30th. And you can see it got very steep, but not particularly inverted. But since then, it started inverting. And right now, actually, we're seeing more inversion on the 2s to 10. So in other words, if you subtract the 10-year Treasury yield, if you take the 2-year yield and subtract it from the 10-year, that should be generally a positive number. But now the 2-year is higher than the 10-year, and that's unusual. And it's actually more inverted than I've seen, at least when I look at it over the last few months in quite some time. And that's usually an indicator that a recession is coming. And there's a lot of different theories on why it happens and what that means. But generally what it means is, the Fed can control the short end of the yield curve sort of always through the Fed funds rate. And unless they're actively buying and selling bonds a lot through open market operations, they can't control the long end that much. But essentially, when they push the short end up like this, usually what that means is that the long end is going to rise eventually as well. And that the short end is just sort of, again, a leading indicator for what's going to happen for the rest of the curve. But some market participants are saying that, sorry, we have a mouse problem that keeps jumping ahead. Some market participants are saying that, whatever the Fed does with the short end of the curve, that this longer end of the curve is probably going to stay pretty solid, just because of demand for yield from giant yield consumers like pension funds and things like that. So, I wouldn't speculate on that myself, but it is notable that the yield curve is so inverted. And that's one of the things that every time I've been through a number of market cycles in my career, and every time the yield curve inverts, there's always a lot of discussion on why this time is different, and we won't have to have a recession, and we can have a soft landing. And honestly, usually you end up with a recession. But like we talked about before, we may be at the tail end of this recession already. So the thing to keep in mind is that the Fed has a lot of power, and it's probably unlikely that they'll let us suffer too much if the market starts struggling. And we'll talk about why that is in a minute. We already talked about the steepness, talked about mortgage rates. This is just another observation, and it keeps getting worse and worse. Back when this gold line was here, we talked about how crazy this was, but this just shows if you do essentially 2 6-month CDs, in other words, a 1-year CD, the blue is how much money you would make. That for $100,000, you used to make about $10,000 from that in the early 90s. And now if you buy a $100,000 CD for a year, you probably make about $300. But with inflation at 9%, you can see that you're actually going to lose almost $9,000 in purchasing power over that year. So that just is more reinforcement that people say cash is king, but Ray Dalio likes to say cash is trash right now, and this definitely is, I'd say, evidence of that. We talk about I bonds a lot, and if you had an I bond, essentially the gold line would just be right at zero right now. In other words, you would make just enough money on I bonds to keep up with inflation, but not exceed inflation. But you probably pay tax on that money from I bonds, and there's penalties if you get out of them before 5 years, and you can't get out of them all before 1 year. So cash is trash, but I bonds are not the solution, in our opinion. Something like a diversified portfolio with lots of good stocks in them that has an actual chance of a real return that exceeds inflation. That's the kind of thing you want to do to combat a curve like this. This is just, we're kind of in the macro grab bag, but it's interesting to see that, leverage has come down a lot for companies just because they've been building their war chests with cash. And also, I think they're leery of being over leveraged like large companies certainly were before the financial crisis. So this does indicate the potential that, companies will fare better in this recession if it comes or is here than typically. Finally, this just shows the trajectory the Fed is expecting. So right now, we're at 2.5%. They think that they're going to get up to 3-something% before the end of 2022, close to 4% by the end of 2023, and then in 2024 they'll start cutting rates again. But of course, there's a lot of speculation they might have to do that sooner. So we'll see. Something else that's really important to talk about is the Fed's balance sheet, which is really almost more important than the Fed funds rate. The Fed funds rate, the short-term interest rates get all the attention, but the other thing the Fed is doing is, if you probably remember the term quantitative easing, they were buying bonds in the open market. We talked about that a little bit, but they were buying lots of treasuries and even other types of assets that really helped keep yields down. And now you can see that their balance sheet has jumped up to a pretty high level. GDP is only about 22 trillion a year or something. So something like half of the US output, at least in a notional sense, is sitting on the Fed's balance sheet, which of course that's not really that meaningful because it's, again, not like anybody can spend this money. It's sort of there as an artifact of the financial system we have now. It's just like something like, Bitcoin that has a market cap of trillion, or even the stock market itself. The stock market itself has trillions of dollars in market cap, but it's not like everybody could pull all those trillions of dollars out all at once because there has to be a buyer there. So, even if people did try to sell, somebody would have to be buying it, prices would crash. So it's not like that money really exists, like a $20 bill in your pocket exists. But so what they have started doing is I actually went and started reading what the Fed's up to because, people talk about it, but it's interesting. So what they're doing right now is essentially for Treasury securities, what they're saying here is the first $30 billion of either interest or maturities they have every year, they're just going to let that roll off and let their balance sheet shrink by that much money. And then they'll reinvest that money for anything over the first $30 billion of principal each month. And then they also own mortgage-backed securities to help the housing market. But again, the same thing as actually, I think the interest on the stuff the Fed owns actually goes directly back to the Treasury. But when they get principal from stuff that matures, it used to be they would just reinvest that in the markets. But now they're saying the first 17.5 billion of principal from mortgages, they're going to just let their balance sheet shrink like that. So all they're talking about doing right now is 30 plus 17.5 billion, call that $50 billion a month, which is a lot. It's going to have an impact on the markets. But you see, when you're talking about $9 trillion, just to get a sense of how massive that is, if they did $50 billion a month, that's about 600 billion a year. And so that's probably 15 years. If they did that for 15 years, that would actually reduce their balance sheet to zero. And granted, they're probably not going to reduce their balance sheet to zero for a number of reasons, just like we're never going to get rid of the national debt. There's probably always going to be debt outstanding and treasuries outstanding, but we just want to reduce the debt, hopefully, or at least reduce the deficit. So in the same way, the goal is probably not to get down to a zero balance sheet, but they're only going to be reduced. If they did it for 5 years, that would only reduce their balance sheet by a third, from about 9 to 6 trillion, which is still way over what it even was after the 2008 crisis. So I think what's meaningful is that they were buying bonds until March, I think it was. And now, so to reverse the close to $90 billion of buying a month, and now to start selling 50 billion, well, that's a pretty big swing. And especially when the markets are sensitive, that's very, very meaningful, I think. We already talked about this. This is just the dot plot that shows where the Federal Reserve governors think rates are going to go. And this is a little bit out of order, I apologize, but you can see a lot of people think that cutting might start happening sooner than we think. And I wanted to talk about this, and we'll actually use this slide here because it's federal deficit to US GDP since 1930. So, for example, right at the beginning of World War II, for everything the United States made, 25% of that was essentially being spent by the government. So, I mean, the government essentially represented 25% of GDP of the country, which is huge. And obviously, the World War II was pretty important, but we average about a 3% deficit each year. And you can see that right now we're kind of right back. I mean, we did a 15% deficit in 2020 and a 12% deficit in 2021. So this is big. And, the ways we're going to have to deal with this, one is potentially raising taxes, which probably isn't going to happen, or we could cut spending, which probably isn't going to happen. But we've talked about this before. This higher than normal inflation rate combined with low treasury yields means that we're actually reducing. Well, actually, I think we have a better slide to look at that. Yeah, this is the actual debt to GDP, not just the deficit. So Because of the high inflation level, we're actually bringing down our debt to GDP ratio, but it may not be enough. So ironically, one of the things that if you think about tax receipts, if you go through a period where tax rates don't really change that much, you might think that tax receipts by the government would stay the same, but actually a lot of things drive that. Recessions, employment, booms and busts and all that sort of stuff. But really the stock market, when the stock market's doing well, tax receipts are high, and vice versa. After a big market crash, people get loss carry forwards, there's unemployment. And so a bad stock market is actually bad for this chart. So the Fed, of course, it's not one of their direct mandates, but between the Fed and the Treasury, they're very motivated to, they actually have incentive to keep inflation a little higher than we would prefer. But I think just due to the sort of populist problems and the problems on Main Street, they do want to bring inflation down. But they also want to support the stock market to help support tax receipts to keep this whole thing rolling forward. So you can see, this is a chart I like to show. It's really interesting to see if you look at what we spend money on, and it's pretty interesting that if you just do Medicare, Medicaid, and Social Security, that's already almost $3 trillion a year. And then you add on defense and a couple other things, and then we spend about $6 trillion a year right now as the government. And income tax receipts and corporate tax receipts are only about $3 trillion. Anyway, that's that. Social Security and Medicare taxes are a pretty good chunk there, but we're having to borrow, issue about $1 trillion in treasuries a year, of new treasuries, just to keep up with the spending. So it's not something that's probably sustainable. If you look at this chart, there's been research that if you get much above 130% of debt to GDP, there's not a whole lot of examples of countries that have worked their way out of it, meaning that usually it leads to an inflationary spiral or a default, or default on sovereign debt. So I don't think that's going to happen for us in the U.S. The world currency reserve status does help, but the point is, this is not an esoteric pie in the sky theoretical issue. I mean, this is a very real issue, that debt to GDP was trending towards 130%. And people say, well, Japan's is something like 200%. It's very high, but Japan has huge reserve assets of international stuff like dollars and treasuries that they have available to spend. And also they don't have a trade, they have a budget deficit. They spend a lot of money fiscally, but they don't, they export a lot more than they import. So the US, we do have the reserve currency thing going for us, but the issue is that we do have what they call, pretty massive dual deficits, which means we run a budget deficit, but then we also import dramatically more than we export, which that math doesn't work out very well, especially when you have a lot of indebtedness and a high debt to GDP. So we're closing out here. We just have a couple more minutes. So if you do have any questions, put them in the box. We'll try to leave a couple minutes at the end. But this is really, we wanted to focus on this because it's kind of unprecedented. I would say unprecedented, but some people have been surprised at how strong the dollar has been. And there's a thing called the dollar milkshake theory you can Google, which suggested that this is exactly how it was going to play out, that in an environment like this, the dollar would strengthen dramatically before it weakens a little bit. But essentially what we're doing is, one way of looking at it is these dollars, the Fed, they're keeping rates low, but now they're starting to raise them. And so it's really, anytime you raise interest rates in a country, that tends to strengthen the currency. And when that happens, that's creating all kinds of problems elsewhere in the world. So, some people are saying the Fed is sort of exporting these problems that we're having to the rest of the world. But hopefully, I've heard, Jeff Gundlach is another person that I follow. And his theory is that when the dollar starts falling off and this Dixie index goes below about 100, that's the time that, he says he's going to start jumping into emerging market stocks and stuff like that. We're already as we mentioned before, we have a strategic allocation that doesn't change a lot. So we already have exposure to emerging markets that we've rebalanced into as they've underperformed a little bit. But the point is, if you're one of those people that's been holding your breath, waiting for some performance out of your emerging market positions, well, as the dollar declines, if it declines as expected, as the dollar declines and starts falling to a more reasonable level, that's probably the time you're going to see some leadership and outperformance in emerging and even just developed non-US type positions. So the last thing I want to put, I've actually been closing these kind of briefs with this slide just because I really believe in it. There's a lot of confusing information out there right now. I mean, just for example, when a strong jobs report comes out, these days that makes the stock market go down because the concern is the job market's too hot. So that means that the Federal Reserve is going to have to hike more and be more hawkish. But that's just one step too far for me. And what I've really decided, at least for me personally, obviously my opinion isn't going to influence the world, but when you think about what you root for or what you hope is going to happen, sort of my philosophy now is I really hope for anything that in the long term will improve real per capita GDP. So again, we're not just invested in the US, we're invested throughout the world. So we need to keep ahead of inflation. Even if populations start declining in the developed world, as long as real GDP is growing per capita, that means if you told me that was going to happen for the next 50 or 100 years, I would feel pretty good about what's going to happen in the stock market for the next 50 or 100 years. So we keep an eye on this. You see it did tick down pretty dramatically after 2008 and 2020. And just recently with this recent downturn in inflation, but it's nice to see in this this data point, just see a little bit of a tick up there. That's reassuring and it makes me feel good about the future. So it's good to see that. So that's all we have for tonight. I do apologize. A couple of the slides got kind of out of order. We'll do a better job of collating them next time, but thank you for the question. If anybody else has any other questions, we'll get it answered. And we're going to have some interesting content coming up. We don't want to announce it quite yet until we get it finalized, but it'll probably be several periods until we do another just general market update like this. But in the meantime, please don't hesitate to reach out and let us know if we can help. That's what we're here for. We're trying to write better content for you to keep you in the loop. We're trying to make videos. We're trying to really share sort of our thoughts and opinions and oftentimes reassurance with clients and prospects, however we can do that. So if there's any topics you'd like to see covered, the other good news is I think we're going to diversify the presenters a little bit and get someone other than me on these sessions to talk about some things. We're going to have some special guests. We actually have a guest from one of our fund providers booked up for September already. So we're going to try to continue to evolve. So again, appreciate you watching and don't see any questions popping in right now. So we'll cut off here a couple minutes early. So thanks again for watching and let us know if we can help further.